What is an IRA? Hi there, it's Luigi, and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you enjoy watching our videos, feel free to like, subscribe, and hit that notification bell so you get updated whenever we upload a new video. In today's video, we are going to explain to you what an IRA is, the different types of IRAs, and their benefits. So if you dig these kinds of videos, then keep on watching. Individual retirement accounts, or IRAs, are tax-advantaged savings accounts that people can create to save and invest for the long term. Individual retirement accounts were set up by the Employee Retirement Income Security Act of 1974. Congress originally made traditional IRAs to serve two purposes. The first was to give people who didn't have a retirement plan at work a tax-advantaged way to save for retirement. The second was to support the employer-sponsored retirement system by keeping rollover assets when people changed jobs or retired. Since then, policymakers have made changes to IRA rules and added new types of IRAs. Millions of US households have been able to save for retirement thanks to IRAs. An IRA, like a 401k account provided as a benefit by an employer, is intended to encourage people to save for retirement. Anyone with a source of income can create an IRA and benefit from the tax advantages these funds provide. An IRA can be opened through a bank, an investment firm, an internet brokerage, or a personal broker. Anyone with earned income can open an IRA and put money into it, even if they already have a 401k through their job. The only limit is how much you can put into your retirement accounts all at once in a single year and still get tax breaks. When you open an IRA, you can choose to invest in stocks, bonds, exchange-traded funds or ETFs, and mutual funds, among other things. There are even self-directed IRAs, also called SDIRAs. These let investors make all the decisions and give them access to a wider range of investments like real estate and commodities. There are four popular types of IRAs: traditional, Roth, SEP, and simple. Here's an overview for each one. Traditional IRA. With a traditional individual retirement account, people can put the money they earned before taxes into investments that can grow without being taxed. The IRS doesn't tax capital gains or dividends until the beneficiary takes money out of the account. Individual taxpayers can put in 100% of their earned income up to a certain maximum amount of money. There may also be income limits. Depending on the taxpayer's income, how they file their taxes, and other factors, contributions to a traditional IRA may be tax deductible. People who want to save for retirement can open a traditional IRA through their broker or financial advisor. This includes online brokers and robo-advisors. Traditional IRAs let people put money away for retirement before they pay taxes on it. This money can grow tax-free until the money is taken out at retirement at 60 years old. Custodians, such as commercial banks and retail brokers, hold traditional IRAs and put the money in different investment vehicles based on what the account holder wants and what is available. Most of the time, you can save money on taxes by putting money into a traditional IRA. If someone puts $6,000 into their IRA, for example, they can claim that amount as a deduction on their income tax return, and the Internal Revenue Service, or IRS, will not tax those earnings. Roth IRA. A Roth IRA is a type of tax-advantaged retirement account in which you can put money that you've already paid taxes on. The main benefit of a Roth IRA is that earnings on those contributions can grow tax-free and can be taken out tax-free after age 60, as long as the account has been open for at least 5 years. The main difference between a Roth IRA and a traditional IRA is how the money is taxed. Roth IRAs are funded with money that has already been taxed. This means that contributions are not tax deductible, but money taken out of the account is not taxed. Regular contributions to a Roth IRA must be made in cash, which includes checks and money orders. Securities or property can't be used. The Internal Revenue Service puts a limit on how much can be put into any type of IRA each year and changes those limits from time to time. Both traditional and Roth IRAs have the same limits on how much you can put into them. All of your IRAs have the same limits, so even if you have more than one, you can't put in more than the maximum. SEP IRA. Self-employed individuals such as independent contractors, freelancers, and small business owners can set up SEP IRAs. The acronym SEP stands for Simplified Employee Pension. Most of the time, SEP IRAs are for people who work for themselves or own small businesses with few or no employees. The contributions are tax deductible, just like with traditional IRAs. Investments grow without paying taxes on them until retirement, when the money is taken out and taxed as income. When business owners set up SEP IRAs for their workers, they can deduct the money they put in on behalf of their workers. But employees can't put money into their accounts, and when they take money out, the IRS taxes it as income. Simple IRA. Small businesses and people who work for themselves can also use the Simple IRA. Savings Incentive Match Plan for Employees is what SIMPLE stands for. When you take money out of this type of IRA, it's taxed the same way as a traditional IRA. Simple IRAs are different from SEP IRAs in that both the employee and the employer are required to put money into the account. All of the contributions can be deducted from taxes, which could put the business or employee in a lower tax bracket. What are the benefits of an IRA? An individual retirement account, or IRA, is a tax-advantaged way to save for retirement. Depending on the type of IRA you have, it can either lower your tax bill now or when you retire. Gains from investments are usually not taxed. The Federal Deposit Insurance Corporation, or FDIC, which is run by the government, protects IRAs if a financial institution fails. The FDIC protects customer deposits up to $250,000 per account at banks or savings and loan associations that are insured by the FDIC. Many financial experts say that you might need up to 85% of the income you had before you retire. A savings plan offered by your employer, like a 401k, might not be enough to help you save up the money you need. You can put money into both a 401k and an IRA, which is good news. An IRA can supplement your current savings in your employer-sponsored retirement plan, get access to an investment plan that might give you more options than the one your employer offers, and take advantage of growth that could be tax-deferred or not taxed at all. Is it better to have a 401k or IRA? You can have both, actually. You can save more for retirement by getting the full employer match on your 401k and opening an IRA. If your employer doesn't match your 401k contributions, if you plan to max out your 401k, or if your 401k has few investment options or high fees, it might be best to put most of your money in an IRA. The main difference between an IRA and a 401k is that 401ks are offered by employers while you open an IRA by going to a broker or a bank. IRAs usually have more ways to invest, while 401ks let you put in more money each year. You can also move money from an old 401k into a rollover IRA. When a rollover IRA is done right, the money keeps its tax-deferred status and doesn't have to pay taxes or penalties for early withdrawal. When can I take money out of my IRA? After age 60 is the best time to take money out of an IRA. If you take money out before you're 59 years old, you will have to pay taxes and a 10% early withdrawal penalty. Some people don't have to pay this penalty if they have medical bills, a disability, or something else out of the ordinary. In general, the longer you wait to take money out of your account, the more time that money has to grow. The least expensive IRA options can be found at no-load mutual fund companies, online brokerages, and robo-advisors. Before you compare IRAs and decide where to open one, you should think about what kind of IRA would work best for you. Also, remember that choosing among the different types of IRAs is not an all-or-nothing decision. You can have two at the same time, but your annual contributions can't be more than what's allowed. And that's it for today's video. If you enjoyed this video, don't forget to like, subscribe, and hit the notification icon so you can be notified whenever we upload new videos. Thank you so much for tuning in to Catapult Capitalism, and we'll see you later.